Hey everyone, welcome back. Michael Rosmer here with Richucation. We're here for our third day of our fantastic investment series, all right, a mini series on investing. And we left off previously, we kind of laid the foundation of investing, and we went into some of the specifics about what asset classes are and where you should focus. Today we're going to talk about what we call Warren Buffett's rule number 1 and rule number 2. What he'll say, rule number 1 of investing is don't lose money. Rule number 2 is never forget rule number 1. All right? And I promised you guys that in this video and the next video, I'm going to really get into how to get superior returns. We talked about how that extra 4% can be worth $400,000 difference in the course of whatever the number was, 8 years or something like that. I can't remember exactly, but whatever the period of time was, it's worth a lot extra based on a $100,000 investment, right? Like it really adds up. So the thing that I always looked at was I said, all right, it's great, I hear this from Warren Buffett, but how do you do that, right? And the thing that I want you to understand is getting superior returns is partially about not having negative returns. I'm going to show you how this works in just a moment, but you just got to keep this in mind that I resisted this concept a friend of mine gave me years and years ago. He said investment is about managing risk. And I was an entrepreneur. I didn't want to hear the word risk. And I said, no, it's about getting a return on your money. But really risk is at the very heart of it. So what we want is it's this concept called risk-weighted return. Okay, so you might go into some sort of an investment presentation and they say, oh, we pay 10% return. That's not true. Okay. The reason it's not true is because that's not a risk-weighted return. So it doesn't factor in the uncertainty and the ups and downs, all right? This is why when we look at, the general stock market over 100 years paying, say, 8% or 9% or whatever the number is, depending on the years you look at, that's a real return, okay? And that's what we really are focused on. So what's the real return once we factored in all the ups, all the downs, all the everything, okay? Because it doesn't matter. I have a really good friend who I was talking to him about investing, a few months back, maybe a year ago, and he said, this was at the start of 2015. And he said, my investments have done great over the last 2 years, they're up 30%. I said, well, that's basically what the general market is up, so that fund you're talking about that's done so well isn't that great. But more importantly, that was in a really fast rising market. I would expect it to be pretty flat in the next year, which it turned out to be. So I'm going to delve right in here, and I'm going to kind of show you guys not only what is it that makes this such a big deal, and it's a bigger deal than you might think, or a bigger deal than I thought anyway, but also how to prevent it, okay? So we've talked in previous videos about how, stocks or any investment typically doesn't just go at a linear trajectory upwards, right? What it does is it bounces around. And we've talked about how you want to design your portfolio and your strategy so that you're not forced to sell when it's down, because when you sell is really important, right? So we'll draw this same thing we've drawn before, which is loosely a view of the stock market, and we'll say you bought in, right here, right? And the stock market tends to do this, up and down and, this kind of thing. And by the way, I'm saying stock market. This is true of the real estate market, it's true of any market. Bonds, if you're talking about like a fixed rate of return, there'll be maybe less of this. So this is what we call volatility, this up and down. Certain asset classes have less volatility. So options have very high volatility. Stocks have lower volatility but higher than real estate. Real estate, again, is less volatile than stocks. And then you'll typically get into some other things like a government bond will typically have less volatility still, okay? So let's imagine here, if we just pay attention to what's going on here, this concept, this understanding how this market goes, this is just a rough graph. It's not representative of any particular period in the market or exactly what any stock looks like or anything like that, but just to show that it's going to fluctuate, it's going to go up and down, okay? Now, when Warren Buffett says don't lose money, he's not entirely saying, hey, listen, don't have it go up and down, okay? That's going to happen. His holdings do that all the time. And so we're going to talk about kind of the first piece of what this means, all right? If it goes, let's say instead of going up right here, it went down. And let's say that this is 0, okay? So say it goes down to 0. Now what's the problem with that? It's impossible to recover, okay? If it goes down from, it doesn't matter what it's at, it could go up 1,000,000% in a day. If it drops down 100% to 0 the next day, you cannot recover from it, all right? And so this is a starting lesson, is you cannot recover from 100% loss. So you never, ever, ever want to put your investments in a position where you have a chance for 100% loss. Now, I know most people go in not thinking there's going to be a 100% loss, but you want to make sure that the way you're set up structurally is going to mean that you can't have 100% loss, okay? So that's the first lesson of don't lose money, is you cannot recover from 100% loss, and we're going to talk in a minute about what to do to protect yourself. Don't worry about that. But you got to make sure this is at issue. Now, what's the next piece? Well, let's say that instead of immediately starting to go up, this went down by, let's say it went down 10%. Okay, so it goes down 10%, then it comes up. Here's the interesting math. Okay, and I'll use actually 50% because it's an easier number. If a stock goes down, so keep in mind, typically the market goes up on average about 8 or 9%, 7 to 9, depending. We'll just call it 8% a year. Okay, that's like a typical increase, and rarely will it do that in a year, but it'll go up 20, and then it'll go down 3, and then it'll, it's all over the place. But in the aggregate, in the big picture, you're looking at being up 8% a year. Okay. If it drops by 50%, how much does it have to go up in order to get back to where it started? 50%? Went down 50%, it needs to come up 50%? No. If you start with $100, it goes down by 50%, you now have $50, it has to go up 100% to get back. Okay? So the downside returns have a disproportionately higher effect than the upside returns. Okay? And this is one of the reasons why, if all you ever could do was prevent yourself, so you just locked in right here, okay? You said, okay, coming up, coming up, coming up, locked in, you'd be far, far ahead in most cases than if you have to weather this up and down. And there's another interesting thing, that volatility, going up and down like this, actually hurts your returns, interestingly. And again, somebody showed me the math, and I was like, what? That doesn't make any sense. And I'll give you an example. Okay. Let's say we have a 5% average return year over year, okay? So 5%, and that happens for 6 years. Now, whatever the number happens to be, I don't remember what the return is. Over 6 years, it's going to be more than 30% because the 5's compound, but whatever it is. Now, let's say that it did 8% a year, so 3 higher than 5, for the first 3 years, and then it did 2% a year for the next 3 years. So, just works out that way, right? Now, what is your ultimate rate of return? You might say, oh, it's the same, because the average return, okay, how do you calculate an average? You go 8 plus 8 plus 8 plus 2 plus 2 plus 2 equals 30, okay? So in this case, 6 plus 24, 30, which is the same as 5 times 6, right? So that's a 5% average rate of return. But the way that rates of return work are that they compound against each other. And this is, you can see it, the extreme example is the one that I just gave you, okay? So let's say that you had, things went up by, I don't know, let's say they went up, well, in this case, let's say they went up, on average, over the course of 2 years, they went up 150%, okay? So that 75% a year, let's just say that was the number, okay? So 150, or hang on, no, 50%. So it went up 25% the first year, and then 25% the second year. Okay, so you're going to have a little over 50% total return, not because you're going to go 1.25 times 1.25 to get your actual rate of return. Okay. Now, if it goes down by 50% the first year, and then up by 100% the next year, what's the average rate of return? You would go 100 minus 50 equals 50. Right? So in theory, you say, okay, those two periods were the same. The 25, 25, or 50 and then 100 shouldn't matter, right? Except that it does matter. The fact that it was more volatile meant that in the example where it went, it doesn't matter which order it is, whether it went up 100 and then down 50, or whether we're at down 50 and up 100, you get back to 0. That's where you're at. Versus if you did 25 one year and 25 the next year, you're over 50%. Okay? So that's how volatility hurts you. And it's not necessarily enormously problematic, but we put some strategies in place that help to eliminate that, which really smooth out this curve, which actually means you end up with more money in the end. Okay? I don't necessarily expect you to follow that, but just bear with me and understand that when things go down, it hurts you more than when they come up. If you have the price drops by 10%, you don't need to go up another 10% to get back. You need to go up, it's about 11%, right? Because you went down from 100 to 90. 90 times 10% is 99. You're not there yet, right? So that's why you don't want to have downside. You want to correct and prevent this downside. And that's what we're working on today. What we're working on today is all about, we want you to protect yourself against the downside. And you'll have some volatility like that. You're not going to get away from it. But we're going to protect you from that downside. And in doing that, we're going to massively increase your returns. Okay? All right. So interesting first thing is fees. Okay, we're going to talk a little bit about fees. I see it's especially common in what I would call exempt market products or small private placements, things like this, that the person who is selling an investment, who you might sometimes think is an investment advisor, usually they know nothing about investments, or very, very little. Whether they've taken a course or not, they aren't doing well investing. That's not their expertise. What they're doing is selling. Okay, they're salesmen. Now, those salespeople who are selling it to you will get, say, a 10% commission. And it varies. Sometimes it's 2%, sometimes it's 15%, and everything in between. But just understand how this works, okay? Let's say a company tells you, we're going to give you a 10% a year rate of return. You're locking your money in for 3 years, okay? So at the end of it, we're going to pay you, let's just say it was a simple 30%, okay? What's the problem? Well, the first problem is day one, they don't have all of your money to work with, okay? They have 10% less than all of your money to work with, all right? So 10% less means they have $90, let's say, instead of 100, or 90,000 instead of 100,000, okay? $90,000. Well, to try and get a 30% return in 3 years off of $100,000, you know, feasible. Doing it off $90,000 is now a lot harder, okay? Add to that the fact that they have to make profit themselves, okay? So they need to make money off that. So let's say they need 5%, right? So they really need 45% instead of 30%, but they have to do that 45% with 90,000 instead of 100,000. So in the end, they need to come up with 145,000 using only 90,000. Tough, okay? So you really want to pay attention to fees, and we talked a little bit about it in the last video where we were talking about low fee mutual funds or low fee funds, things like ETFs. But fees will crush you if all you do, okay? If you just do these two things, you will be ahead of the majority. Minimize your fees. So basically you're investing the exact same thing as everybody else, but without the fees, okay? You're way ahead. Number two, you minimize your taxes. And in the last video, we're going to talk about tax structuring and show you how, I mean, you could lose 50% of your income off of taxes. So if you just eliminate that, you're not just double the other person. Remember we were talking about the law of 72 or the rule of 72? Well, that 50% extra return, let's say that instead of getting 8%, you're getting 4%. 4%, how long does it take for that money to double? It's going to be 72 divided by 4, so 18 years, right? So versus 9 years. So in the first, basically you're talking about not just double, right? Let's go and do our numbers. We go up here, you've got 8% versus 4%. Here it's going to take you 9 years. Here's going to take you 18 years. So by 36 years, this one isn't at half. This is going to actually be, so we're going from here, we're going to go 2, 4, 6, 8. So instead of getting, let's say you went from 400,000, you're now at $800,000 difference. Huge, huge difference over the course of the lifetime of that investment, okay? So that's not a $100,000 investment. Anyway, I'm giving you kind of simple numbers. Those are not 100% accurate, but I just want to show you how tax planning makes a really, really big difference. And we're going to talk about it in a lot of detail in the 5th video to show you exactly what you need to be doing. Do you need to be using that 401k, the Roth IRA, the RSP, the TFSA, the whatever it is in your particular country, international structures, corporations, all that. We're going to talk about it, okay? For now, what you just need to know is you want to minimize your fees, and that's just paying attention to the investment you're in, okay? There's not a ton that you can do aside from that, aside from being aware that there's always fees, always, 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 and minimize them, okay? Now, here's where we're going to start to see some really interesting stuff, okay? Because let's say that the average rate of return over this whole time here, and I'm going to say actually actual, okay? So the difference between an average and actual is we just talked about it, right? The average return on the 100 and then 50 was 50, but the actual rate of return was 0, or 0% growth, right? Versus the other one, where the actual return of 25 and 25, the average return was, 25, I guess, per year in both of those scenarios, so 50 overall. But in reality, it was over 50 because there's compounding. Okay. Now, I hope you guys are following this. I apologize. I'm going fairly quickly. You can pause the video. You can go and rewind to try and understand it. But let's just say that the actual return over time, averages out to 9% a year. Okay. Now, that might be true, but that's not necessarily true at any given point. So let's say you made the big mistake of investing all of your money right here. Okay, it just went spiked and now it crashes. Okay, it would be a little bit like investing all of your money in, the start of 2008. Okay, sounds great. You're like, okay, the money market's going to average 9%, but it takes years to be back at break even because the market's about to take a plunge of 50%. And it's going to take a number of years to get back there. Okay, so this is where we're going to talk about the first part of the strategy that you should be doing at this stage. Now, there are times when this is not the right strategy, but for you right now, just following where our sequence is, okay, you're making more money than you're spending, you've paid off your debt, you've got your reserve fund, you've got collateralizable assets, now you're looking at investing, you want to do something called dollar cost averaging, okay? Dollar cost averaging basically means that you're just going to put a certain amount of money in every, be it month, quarter, year, whatever that time period is. And why is that? Well, the reason is that you have no way of knowing where you are on this, right? Like, it's very difficult to predict. There are some things you can do to learn, and we're going to talk about that in the next video, which is going to really supercharge your returns. But for the most part, you're not smarter than the market. Trying to predict, is it going up tomorrow? Is it going down tomorrow? You don't know. So what you want to do is you want to pick productive assets, such as real estate, as well as such as a low-cost index of the S&P 500, and you just want to routinely put in money. And what is that doing for you? It's protecting you from investing all of your money at the wrong time, okay? So if you're investing all the time, then, okay, you're buying here, 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 all the way along, okay? And this is going to average out, it's going to hit the average, right? Because you're doing it all the way along. Versus if you said, oh, I think here it's dropped all the way, I'm going to buy a whole bunch. Now it drops a whole bunch more. You have no money to invest. You can't take advantage of this upsurge. So instead of doing that, you want to just used to be buying, 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 buying. Okay? Very straightforward. Then, so that's the first concept, dollar cost averaging. All right? Pay attention to that. Next principle that you want to pay attention to is, all right, within whatever it is that you're doing, okay, whether you're buying real estate, whether you're buying a car, whether you're buying a stock, there's some uncertainty, okay? Now, we'll talk about this in just a minute. Let's think about buying a car, okay? If you've ever bought a car before, which I bought many, once in a while you get a lemon, all right? How do you know you're going to get a lemon? Very difficult to say. Maybe if you're some sort of an extreme mechanic, you can do a detailed inspection and figure things out. But honestly, even then, very hit and miss. Like, sometimes bad things just happen. You buy that car fresh off the dealership lot, and it's a bad year. My parents had that with a a Dodge Caravan years and years ago in the 80s or something, and they went through like 4 transmissions with it. You know, you just got a bad one. You know, how do you predict that? You don't. How do you protect against it? You diversify. Okay, so you just have to know that a certain number of them aren't going to go well. Okay, so if I buy certain properties, once in a while I'm going to buy a property, and yeah, I'm going to do my due diligence. I'm going to try and make sure there's no cracks in the foundation or no serious issues. But sometimes you're going to buy one, the furnace is going to go, the hot water tank is going to go, you're going to need a new roof, you're going to have structural problems, you're going to have a sewer backup, and you have insurance to protect against some of that, but some of it's going to be rough. You know, you're going to buy at a certain time, and you're going to have a bad renter or whatever. Okay, so the way that you protect against that is by spreading it out. Okay. In real estate, it's tougher to do this. It's one reason that you might prefer to go with stocks or real estate. That is to say, an index fund. But the bottom line is you're going to have some bad apples. Enron is a good example. How could you have predicted Enron? You could have if you understood the due diligence. That's why people like Warren Buffett weren't invested in Enron. But generally speaking, you're in a position where you aren't going to figure that out. You aren't going to have that expertise. But if you diversified across 500 companies, like the S&P 500, the top 500 companies in the country, then relatively speaking, the amount of your money that's going to be represented by any one of those is pretty low. Pretty low, okay? And so this is what you want to do, is you want to split it up. You want to diversify. Now, diversification is sometimes diversification, and I'm going to contradict myself a little bit in the next video when we get into advanced strategies, because as you develop expertise, the way you maximize your returns is to concentrate a little more. And Warren Buffett will talk about that. But at this stage, go for diversification. Okay? Diversification is buying that index of the S&P 500. Okay? So that's basically our kind of second, third rule, depending on how we look at this protecting your downside thing and the fees. Okay? So, protect against your, you can't recover from 100% loss, so don't do that, and we're talking about how to protect it. That's our core piece here. Minimize your fees. Make sure you dollar cost average, so you protect yourself against time uncertainty, right? What time window it is. Number 3, diversify, okay? And the easiest way to diversify is just to buy a low-cost index fund of the S&P 500. If you dollar cost average it, you're going to be fairly okay, all right? You're not going to get the super returns. We're going to talk about the super returns later, and that's really a big deal. But as you're building up your portfolio, this is where you're starting. Okay, a lot of it's about sequence. It's not about just what you do. It's also about when you do it and in what order. Okay. Now, what about if we've planned things out properly, like we talked about the portfolio building at the beginning and preparing, your need for sudden cash should be minimal. Okay? That being said, you might find yourself in a position where you are going to need sudden cash, or you're not going to want to have this happening. Okay? How do you protect yourself against that? Okay? How do you protect yourself against these fluctuations? Maybe you're somebody who's retiring, you're on a fixed income. You really want something that's more like this. Okay? The way you get that is through something called asset allocation. What is asset allocation? Well, if you understand the way that markets work, for the most part, you don't have, money is not disappearing or increasing. It is a little bit, but generally not most of the time. What's happening is money is moving from one place to another, and that's based on what seems like the most attractive investment. So if this here seems really attractive, then money's going to come out from over here and move to over here. Now, money moving into something increases how much it's worth, and money moving out of something decreases how much it's worth. Okay? So I'll give you an example. If you have bonds and the stock market, these are the two commonly contrasted ones. If interest rates go up, okay, so instead of paying 2% a year, they pay 5% a year, well then that's considered to be the amount of risk has remained the same, so the return is better. So that means that some money is going to flow from here over to here. Okay, that's going to cause this guy to come down. That's going to cause this guy to come up. Okay, this is one of the things about real estate. One of the reasons we've seen real estate values rise as much as we have is it's been a negative interest rate environment. So if you go back to 1980, thereabouts, when the interest rates were at like 18% or whatever they were, you had, since then, you've seen the real estate prices steadily rise, more or less, right? There's, up till kind of the 2008 period. And yeah, there's bumps along the way. But overall, you've seen a rise that goes faster than the rate of inflation. You say, okay, well, where's the money coming from? Okay, so there has to be more money for things to rise in price. Well, where it's coming from is interest rates are dropping. Interest rates have gone from like 18% or whatever to 3%. All right, so that means that the cost of owning it, the cost of that mortgage, has come down a lot, which has disproportionately pushed up real estate prices. And what we should see over time is we should see those interest rates correct. How long this will take, we don't know. That's speculation, right? But that's going to mean that interest rates or real estate prices, not in any individual place, but if we take the big picture of them, will be more stagnant over the next little while than they have been in the previous 30 or 40 years. Okay. All right. And there's a few other factors in there. I'm overly simplifying it, but it just gives you a general idea. The reason that I tell you that is because when you understand, this is called non-correlated assets, okay? So the way that this one behaves, oftentimes if you have, let's say you have 5 bank stocks. So I'm in Canada, there's 5 major banks, and I love investing in the Canadian banks. They're very solid, etc. But they tend to move as one, connected. So diversifying between them doesn't necessarily protect you from this up and down, okay? It can protect you from a major fraud at one of them, right? Something like that. But the general ups and downs of that industry, they're going to generally move together, okay? Some a little bit, not in perfect harmony, but generally. So the way that you protect against that is you go with something that's not related to it. It's kind of opposite, right? So in this, we're talking about bonds and stocks, right? And you rebalance your portfolio. So this is another way that you're going to protect from losing money. You're going to protect a little bit from this volatility. Now, the best source for this is Ray Dalio. He has is the master of asset allocation. He has something called the All-Weather Fund, and he has a particular mix we're not going to talk about here, but basically it's a mixture of stocks, bonds, gold, and commodities. Okay. Now, in our particular case, we're going to talk a little bit about, we've already built up, we've got that cash reserve, we've got ourselves with our nice collateralizable dividend participating whole life insurance policy. So that's helping to create a little bit of balance for us in general. And generally we want a productive asset. So generally productive assets will outperform bonds. His is heavily weighted in favor of bonds because of the risk profile, and that's not something that you need to understand right now. But the general idea is if you're going to have a situation where you might need money, you generally want to split up and put some of your assets into something that has non-correlated returns, okay? And so that's usually going to be a small percentage of your money in gold or other commodities, and a small percentage of your money in bonds, okay? Generally speaking, right now, like, bonds are not that fantastic. They're very low interest rates, but you want to get something, and you can go longer term bonds in order to kind of help even this out. But you're going to do a little bit of that to protect if you're in a situation where you might have need of money in 10 years or 20 years or whatever, because you don't know what's going to happen, right? It could crash, and then you're caught unaware. Okay? Now, that gives us kind of the main pieces, except for the last one. And this last one is, in my opinion, the least spoken about and one of the most important in this subject. And I have saved people literally hundreds of thousands of dollars talking about it. And this is the subject of security. Okay? How does security work? In order to explain that to you, I'm going to tell you about a number of situations I unfortunately was quite close to. I got to see people go through around 2007, 2008, and kind of the outfall of that. All right? One, and it's cool to see kind of the evolution of learning. All right? So there were a few different things. One was a series of investments in land development. Okay, we talked in the previous video about how real estate development does not qualify as a productive asset. Okay. What happened was the people who were investing, they put money in order to have this development thinking they're going to get lots at the end. But they don't actually own the lots. Okay? And unfortunately, debt built up, the values changed, they spent too much money, investors lost everything. Everything. Okay? So remember, you can't recover from 100% loss, 100% loss. Another example, there's a company doing, I forget what they called it, but basically they buy life insurance policies at a discount and then hold them knowing that the people who they're holding them from are going to eventually die, and so they're going to cash out and they're getting them at this discount apparently. So again, the investors didn't own anything. The company supposedly owned these life insurance policies, which were supposedly worth something, but the investors, as a result, lost everything. Okay. Another situation where some people went out and they lent money on a property. Okay, and this was a little better. This is a great lesson. It was $100,000 on two properties. Okay, the two properties they had a second mortgage on. Now, whatever the numbers happened to be, this second mortgage was there. Well, when it came time to sell the properties, the bank, who was holding the first mortgage, were forcing a sale. Okay, and the sale price meant that it was less, so that the people who held this mortgage ended up having to lose 30% of their money. They got about 70% of it back. So out of that $100,000, they lost $30,000. Okay, so what was good in that case was they had some security. Okay, what was bad was they didn't have great security. Security is the thing that's going to protect you from this downside. Okay, so let's rewind to the first example, the one where these people bought into the land development company. Okay, if instead of investing into, this was a limited partnership, this is super common amongst land development deals, amongst various different private placements, amongst various different exempt market securities, as they call them. I basically generally recommend you stay away from all those things. Just don't touch them. Honestly, when you factor in the risk, they might claim, 20% a year, blah, blah, blah. It's nonsense for the most part. Usually they're going to lose money. And look at how this works, okay? Just think about this. Let's say somebody's promising you a 10% rate of return, okay? And you say, hey, you know what? I know what Michael told me. He said diversify. So I'm going to get 10 of those different ones in case any one of them goes bad. Smart, okay? But you have a 10% chance that one of them experiences 100% loss. What is your risk-weighted rate of return? Is it 10%? No, 0%. Why? Because of the fact that when that one loser comes in, it wipes out all the gains from all the other 9. Okay, it's actually in that particular example, it's slightly more, so even worse. But the whole point is, you have this negative return that shows up when you risk weight it. Okay, and I just run into people all the time. I had somebody talking to me about it was actually, in a sense, a good investment. It was a multifamily residential, so buying an apartment building. And I was looking at their numbers, and I'm like, well, you haven't factored in all these 10 risks. So those knock 2% a year off of what you're saying the return is going to be when we aggregate it. Okay? That's a complex term. Aggregate it just means put it all together into a basket, basically. So when we factor it all together in the big picture, it might not be for this one, but over time, with enough deals, here's how the numbers are going to work out. Okay? And we want to go based on those solid numbers. Security protects you from a lot of this. Okay? Let's say that instead of going and investing in that land development deal, you'd said, hey, here's what I'll do for you. I'll lend you money as a mortgage on the property you want to develop. Okay? I'll get a first title mortgage, and I'll charge you 10% a year. You tell me that you're going to be paying 20% a year, so you should be happy with this, right? Now, what happens? They screw up, things go bad, whatever. Your security is the property. The mortgage allows you to take the property. So now you own the property. You're protected, okay? And this is what banks do. Banks make a lot of money, a lot more money than you do. You think they probably know something that you don't? Probably. What does a bank do? Rather than banks aren't in the business of going and buying real estate. Instead, they lend money against real estate. They lend it at very cheap rates. They go and they say, okay, here you go. We'll lend up to 80% of the value of that property. All right? That's kind of a typical number. It varies depending on the type of mortgage. Well, let's say 80%. Meaning that we're going to lend on a $250,000 property, we're going to lend $200,000. What does that mean? It means that if anything goes wrong and somebody defaults, the bank can take the property back and sell it to recoup their money. Okay, so that $200,000, pretty safe. Now, why did they go for only 80%? Because they know that it could drop. If it drops, for real estate to drop more than 20%, pretty rare. Yes, it happens. In some places it happens. Sometimes it happens, but pretty rare. And so that becomes your margin of safety. All right, you get into this position where they say, okay, it drops 20%, or we have litigation costs, or we miss out for a little while. Not that big a deal, because at least we can take it back and we have a certain amount of protection. Okay, which is what you would do. You would go to this land developer and you'd say, okay, what's the fair market value of the land today? Not developed, not any of this. What is it today? And they say, well, it's $1 million. Okay, great. I'll lend you, if it was no cash flow, etc., you're probably going to lend way less than 80%. But let's say that you went at 80% or 70%. Okay, I'll lend you $700,000. They can't pay, no problems. Rather than losing your money entirely, which is what happened to the investors, you take the property. Now you own the property. Perfect. So, okay, now I can turn around and I can sell the property. Might take you a while to sell the property. There might be some costs involved in selling the property. You might even take a somewhat loss. But if you own the property, it's almost impossible to lose all your money. Remember protecting ourselves from that 100% loss? Even if you recoup half of your money, you're way ahead of 100% loss. You can recover from a 50% loss. You can't recover from 100% loss. Okay? So that's the concept of securities. You have something to back up what it is that you're investing in, so that if something goes wrong, you can take it back. Okay? Now, there's a few different forms of security that you might have. When you're talking about real estate, you always want one of two things. You either want a mortgage, and you want it to be a first mortgage, unless it's in a very rare case, you might say it's a second mortgage, if there's like massive amount of equity there, and you still have a big buffer of safety. But basically, say a first mortgage, or alternatively, and the reason you want a first mortgage is because if you have a second mortgage, let alone thirds are useless. Just third mortgage really isn't security. Let's just knock that off right there. Don't lend money as third mortgages. Lending money as a second mortgage, if there is a big margin of safety, you could maybe discuss it, but mostly don't do it. And the reason is because the first mortgage holder gets paid out first, and they can end up in a situation. It's okay. A second mortgage is fine if you have the money to buy out the first mortgage holder in case anything goes wrong. That would be the case where it would be okay. All right. So that's one example. Is okay, on real estate you want to have a mortgage, or if you don't have a mortgage, you want a title. Okay. So I see all kinds of investments where somebody will be raising money for a private real estate deal, and I'll ask them. I'll say, okay, well, as the investor, what do I get? So you get membership in this limited partnership. Not good enough. Why? Because you might mismanage it. You might go and borrow a whole bunch of money. You might, who knows? I want title of the property, meaning that it's ultimately my property, and I can kick you away if anything goes wrong, or I want a first mortgage on the property. By either of those two things, I'm pretty safe. Now, there's a third way you could do it, which is you could put it into trust. That's another different option. In certain countries, certain parts of the world where it's difficult to do foreclosures, that's a useful option. But the point is, first mortgage, maybe second mortgage, but mostly not, or title. Those are the things you want for security on the property. Okay? Now, let's talk about businesses, stocks. These, you're going to look at a couple different things. This is where you talk about something called book value. And I'm not going to go into detail in this video. We're going to talk in the next video a lot more about some of the nuances of how to supercharge your returns and analyze investments. But what you really want to look for here is, first of all, cash flow. So if a business is not producing profit, don't invest. Period. Just don't touch it. It's losing money, you have no security. If it's losing money, what can happen is it can just keep going down. If it's making money, so long as it continues to make money, hey, you're getting money. You're getting cash flow. And this is the reason, one of the reasons too, that we buy cash flowing real estate. Residential, commercial, maybe industrial, multifamily, residential. We want something that's paying us cash flow. Farmland might do it. Cash flow. Cash flow is security. If you're getting a payment every month, then every month that you've got the payment, great. You are getting some of your money back. You haven't lost out, okay? So security forms are cash flow, which is actually profit, which you want distributed to you ideally every year or whatever, as much as possible as a protection. Now, sometimes it's better to reinvest. Warren Buffett reinvests all the time. But that being said, what you invest in should be profitable. Never, ever at this stage invest in something that's not profitable. Do you know what that means? Don't invest in startups. Don't invest in business turnarounds where they're in the dumps. Don't go and buy BlackBerry because you think they're going to make a miraculous turnaround. If they're losing money, they're a no-go. No-go zone, okay? For your purposes, you want something that's producing profit and going to continue to produce profit and steadily producing profit. That's what you want, okay? Title and mortgage. You do not want to invest in somebody else owning these things. So this is a thing that people often do. They'll say, oh, you know, I'm going to buy shares in something that's investing in something. No. No, 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 no. You don't want to do that. The exception is, you know, these really big ETFs, etc., where it's basically a fraction of the ownership. But you don't want to go and invest in a limited partnership where they're going and doing whatever. Not at this stage. Okay? Yes, REITs can be good and you can produce returns. We're not saying you can't produce returns. What we're saying is, at this stage, what do you want to be focused on? You want to be focused on things that are profitable. You want to focus on having a title, having a mortgage. I'm going to give you one last story. Somebody came to us at one of the firms that I was with, had participated in, and they wanted to make an investment. It was $150,000 into a property. And fortunately, we were advising them at the time. So we got the people who they were going to be investing the money with on the phone. We said, hey, great, what's the security? They said, oh, we're going to secure it with this property. We said, okay, fantastic. What's the property worth? It was $150,000. I think they said, oh, $300,000. Great, this should be no problem then. Send us over the comparables to prove that it's actually worth $300,000. Should be no big deal, and everything's good. Well, as soon as we said that, they're like, well, you know, it's very difficult to get comparables, you know, there's not a lot similar out there. They started coming with all these stories. We said, well, you want the investment to go through, send us some comparables. When we did the research, it turned out the property in fire sale was worth maybe $15,000. In other words, good chance they were going to default on this because there was no cash flow. Okay, it was a land development project or a real estate development project anyway. And even if they'd had that little bit of security, it was worth such a fraction of what they were putting up that they were basically going to lose close to everything. So you don't be in that position. Do not ever be in that position. Be in a position where your security more than covers the value of your asset. One great way to do this in stocks can be book value, although book value is highly inaccurate, but you can pay attention to it a little bit. At least the point is the company has something there. There's something tangible that's not going to go anywhere, okay? That's going to protect you. Profitability is going to protect you. If a company has hard assets, it can only fall so far because you can sell those hard assets. Something called net current asset value we'll talk about in a future video. Or if it has profit, it's going to continue to produce that profit. It might take time for you to recoup your money, but eventually, provided it can continue doing that, it will do so. That's really the sum of don't lose money, okay? Have security. Always, always, always protect against your downside. Have some security, okay? Diversify. Possibly use asset allocation in order to diversify. But you should. Well, if you've followed our system so far, you'll have a certain measure of protection anyway, because you'll have cash, you'll have productive assets, you'll have collateralizable assets, and that's going to provide you with a certain amount of security in and of itself. And the productive assets, as they fluctuate, can go up. Minimize your fees, okay? And remember, you can't recover from 100% loss. So, and dollar cost average. Do those things. That's going to get you out there and put you, compared to the average person who doesn't do these simple things, you're going to be way ahead. All right? You're going to be way, way ahead of a lot of your peers. So, If you want more specific information, I invite you to go and take our courses. We've got some really fantastic courses on investment, really show you how to, do this kind of thing, right? Double the return that you're getting. Take that $100,000 and instead of it being worth $400,000 in however many years it is, 9 years or 36 years or whatever, being worth $800,000, big difference. You want to learn how to do that? Go and take the courses. It's 100%, all of our stuff is 100% money back guarantee, so you have zero risk. You can go and pay attention to this kind of stuff, go and sign up for other videos, and what I really encourage you to do, most highly, is go and sign up for our action classes. It is the most powerful way to grow your wealth. You get to participate in a community of other people who are doing this stuff. You can ask questions and get personalized answers. You can get access to resources that help you save money immediately. You can get access to other business opportunities, other ways to increase your value. You get weekly training. You get on and on and on. It's the most valuable thing for this amazingly low price. You could pay for coaching, cost you thousands of dollars a month. You pay to participate in big mastermind groups. Again, thousands of dollars a month, tens of thousands, sometimes hundreds of thousands of dollars a year. Or you can sign up for this very small amount of money, gets you a fantastic return. If you aren't getting a return, you can contact us. We actually have somebody who works specifically with you to make sure you're getting a return. So it's really a no-brainer. And like I said, it's all 100% money back guarantee. So go and sign up for, at the very least, some of the training to go deeper. And ideally, go and sign up for the action classes. We're going to see you in the next video.